When technology races ahead and taxation chases behind, what we get is a global economy of tangled in its own rules. As we sail into the next phase of our conference, we now explore the fascinating collision of two powerful forces, technology and taxation. We are living in a world where drones deliver packages, AI drafts business emails, and blockchains verify global transactions in real time. But as innovation speeds up, can our taxation systems keep up? Is the question. This session is designed to unravel the intricacies of indirect tax in a tech-tangled economy, the dance between GST, global tariffs, and digital economy. The session is amply titled Interplay of New Technology and Indirect Taxation, an ambitious exploration of how global tax systems, especially indirect taxes, are evolving in the face of rising technology. Expect stimulating insights, real-world examples, and forward-looking perspectives that might just redefine the way you pursue taxation in this digital world. To navigate this engaging session with poise and precision, we are honored to have with us the exemplary professional, CA Daphny D'Souza, who will be chairing the discussion. Joining her are four brilliant minds, each bringing a distinct perspective to the dynamic interplay between technology and taxation. I now request CA Gaurav Hegde and CA Bantwal Nitin Baliga sir to kindly escort CA Daphny ma'am and the paper presenters to the stage. A symbol of growth, knowledge and impact. And privilege, I take this opportunity to introduce CA Daphny Stella D'Souza, a qualified chartered accountant and a partner at Mrs. MNDR and Associates. Headquartered in Bengaluru, she brings her a sharp acumen in indirect taxation, regulatory compliance, and client representation. Her career began at Deloitte, Bengaluru, where she laid a solid foundation in handling indirect taxation for large corporates and multinational clients. Over the years, she has built a commendable independent practice with a strong foothold in consultancy and departmental representation, and currently leads the indirect taxation division at Fora Advisory Services, Bengaluru. Her core expertise lies in GST litigation advisory, having handled a wide range of assignments, including both audits and scrutiny procedures. Her deep understanding of statutory interpretation and emphasis on accuracy make her an asset in preparing and replying to show cause notices, assessments, and appeals. She has also been actively involved in assisting legal teams on matters before the High Court of Karnataka and Madras. Some of her notable assignments include advisory to Danish companies looking to relocate their manufacturing operations to India, strategic GST consulting in collaboration with senior advisory and high-level representatives before tax authorities. With a blend of clarity, command, and commitment, she continues to leave a lasting impression in the world of indirect taxation. Ladies and gentlemen, let us welcome CA Daphny D'Souza with a round of applause. As we step into this knowledge session, I take this opportunity to introduce our paper presenters. First up, we have Ms. Nisha S Nayak, who will be presenting on the topic GST, versus global tech. Is the system future ready? This paper poses an important question. Can the current GST framework adapt to the complexities of cross-border tech flows? To present her insights, we have Ms. Nisha S Nayak, a CA student driven from the serene town of Udupi, currently pursuing her articleship at CAK Surendra Nayak at MS Surendra Nayak and Associates. A dynamic individual, Nisha has served as the Master of Ceremony for conferences such as Dyota and Vyakyayana for 2025 and has showcased her excellence talent in state-level debates and other competitions. She blends analytical thinking and leadership with creativity, making her presentation one to watch. Now, without further ado, let us invite our first paper presenter, Ms. Nisha, to take over through GST versus Global Tech.
So, imagine this, you're in India and you pay for in codes on an American website. Or you might also stream music from Sweden. Or also attend a webinar hosted from Dubai. All while sitting at home. So, now here's a catch. You're in India consuming all this tech, and is our tax system sitting with us, or is it lost in a different time zone? With that thought, a very good afternoon to all present here, respected chairperson and all my fellow paper presenters. My name is Nisha S Nayak, a CA finalist, currently pursuing my articleship at Measure Surendra Nayak and Associates in Udupi. My topic for today, GST versus the global tech. Is the system future ready? In 2024, the digital services crossed $4.5 trillion, more than Germany's GDP. Netflix, Meta, OpenAI all reach millions in India without setting up foot here. Some taxes are paid under the reverse charge mechanism, but what about the global giants who are often untouched? So in 2017, when India launched GST, it wasn't just introducing a tax, but also orchestrating one of country's most ambitious economic reforms since liberalization. It was structured into CGST, SGST, and IGST, bringing consistency across the states and sectors. It was primarily built around tangible trades and domestic services. Today's tech world moves fast, from Netflix to cloud, maybe AI tools to online ads. Everything is digital and often from other countries. Since these companies aren't physically located in India, GST finds it hard to tax them. So this mismatch raises a question, that is, can India's GST system effectively tax and regulate digital transaction in an age of global tech dominance? Or is it the time to rethink, reframe, or refuturize our system to ensure fairness, compliance, and even the revenue in the digital-first economy? So far we have seen how India is trying to keep up with these tech challenges. So now let us see few challenges that the system faces. First one, that is jurisdiction and place of supply issues. So think of the Zoom or OpenAI this. So none of them have offices in India. So where should GST be charged? In India, where we use the service, or in the foreign nations from where it's provided? So this confusion can lead to double taxation or worse or no tax at all. Next one, that is definition and classification confusion. So there is significant ambiguity in the classification of goods, and that is digital goods and services. Ever wondered if a downloaded game is a product that you buy or a service that you use? Or in case Netflix, is it selling you a movie or a license to watch? So all this might sound simple, but for GST, it's a big headache. So how you classify things changes how tax is charged. Next, that is OIDAR, Online Information Database Access and Retrieval Services. It says that foreign tech giants are meant to register and pay GST. But due to the enforcement is relatively weak over here, these tech giants often avoid this, that is registering over here. So the burden always falls on the Indian users. Next, that is revenue loss and uneven playing field. So Indian startups, they often pay full GST and taxes. But these big tech giants, they use the tricky ways in order to avoid paying their share of tax. So the burden falls over the Indian users. So all these challenges make the confusions or unfairness, even the revenue loss to the government. So what's the way forward? Now let us look at few reforms and recommendations. So the first one, that is redefining digital supply and place of taxation. India already pays these taxes for foreign digital services under reverse charge mechanism, where the Indian recipient pays the tax. But RCM relies on user awareness and voluntary compliance, which is often missing in these startups and small users. So there is a need for a clear digital supply definition. So even though tax is paid where tax should apply where the service is consumed. So there is a need for a clarity between the place of place of consumption is equal to place of taxation, so that the cross-border tech flows go smoothly. Next one, supporting Indian startups and MSMEs. Unlike global giants, Indian startups, they face heavy tax burden and even the compliance things over there. So simplifying procedures and even lower compliance cost can help the level and boost compliance. Next one, future-proofing through international alignment. So as these global digital giants grow globally, Indian GST system must align with the international practices so that India can claim a fair share of tax from the global tech giants too. So all these reforms are making these GST system aim to make it fairer one, clearer one, and even betterer one, in best suited for the future tech flows. Next, as the digital frontier waits for no one, even neither do the tax challenges too. So currently countries are racing towards to upgrade their tax rules for the digital services. So let us see a comparison table over here. So in European Union, it's simplified with the MOS, that is nothing but mini one-stop shop, where it's simplified with one registration which covers all countries to reduce the hassle and even boost the compliance. Next, Australia and New Zealand. It rolled out with the Netflix tax, where the tech giants like Amazon and maybe Google, they have to register and pay GST. Next, that is United States. So where each state is required, each state has its own sales tax on the digital services. Next, in India, the OIDR provision, it said that the foreign tech giants must pay GST, but due to the enforcement weakness, the burden falls over the Indian users. So all this, from this global moves, India can simplify its GST rules and even tighten the enforcement and also future-proof our system. So here's a real test now. Is a GST system ready for the digital age? So let's step into the shoes of a young entrepreneur in navigating this maze. So imagine Ananya, a young entrepreneur in India, she creates a mobile app where she uses AI to help its users to track health and fitness. She also partners with OpenAI to integrate a powerful language model into her app. But as soon as she starts gaining users worldwide, she hits a roadblock. That is, how does she handle GST on this foreign AI service? So legally, India's GST system covers these foreign digital supplies under RCM. But practically speaking, OpenAI isn't registered in India. So Ananya is confused as to who will pay the GST and who ensures that everything is taxed. So this case reveals a deeper truth. That is, India's system, though legally structured, it is it's not practically equipped to handle the borderless, intangible, and even the automated nature of global tech services. So the system isn't future ready. So let us look at few points, that is the legal framework. So as I already said that GST covers the tangible traits and not the AI services. So businesses like Ananya, there's an urgent need for them to expand and modernize the definition. Next, that is enforcement. Enforcement is very weak for the foreign AI services. It's like trying to catch a high-speed jet with the help of a bicycle. So there is a need for real-time AI tools and automated nature of tracking and taxing this foreign digital supplies. Next, tech adaptation. So GST lacks real-time tracking and even the real-time AI and global tracking. So it can't handle the fast-changing digital world over there. So the businesses like Ananya, they fall into gray areas where it might be unfairly taxed or not taxed at all. Next one, policy coordination. It's very slow here. By the time the tech catches with these global tech flows, the technology might have already moved forward. So businesses like Ananya, they suffer because of this delay in the policy implementation. So they are always stuck in this confusion stage. So I would like to conclude by saying that India's GST system was a bold leap. So digital frontier waits for no one. To thrive in a world where code moves faster than commerce, we need more than reform. We need reinvention. One future-ready system, one global vision. The time is to act now. Thank you.
Thank you, Ms. Nisha, for that engaging and analytical overview. A perfect start to what promises to be a power-packed session. Moving on, we have Ms. Vaishnavi Shetty, who will navigate us through the thought-provoking topic, tariffs or triggers. An analysis whether US tariffs are mere trade tools or they are opening a new Pandora's box in indirect taxation. Our presenter, Ms. Vaishnavi Shetty, is a commerce graduate from Tisha College, Mangaluru. She has completed her first year of articleship in BDO, India, gained a solid foundation in the statutory audit domain, and is currently pursuing her industrial training, where she engages with finance in fast-paced global technologies. So now, let us welcome Ms. Vaishnavi Shetty as she takes over the stage.
Good afternoon, Daphny ma'am, my fellow paper presenters, and everyone at the audience. I'm Vaishnavi, and today I want to take you guys beyond balance sheet and into the world of trade, where government policies, global decisions, and billionaire tweets can impact your economy, your job, and your wallet. The topic of my talk is Tariffs or Triggers, the hidden impact of US trade wars. Let's begin, not with a tax code, but with TACO. Yes, you guys heard it right. TACO is a term used in US to describe Trump. It stands for Trump always chickens out. It's a cycle which we saw repeatedly. In April, Trump imposed flat 10% tariffs on almost all imports. Markets panicked, businesses stumbled to respond. But within weeks, under pressure from retailers and rising prices, administration had to delay or soften the policy. By May, over 150 product categories were exempted, including medicines, textiles, and electronics. That's TACO in action. Big threat, electronics, but, I'm sorry. But these exemptions, over 150 product categories were exempted, including electronics, medicines, and textiles. But these exemptions were partial and inconsistent. Critical components like API, which is used in medicines, industrial fabrics, and microchips used in electronics were still covered under taxes. That's TACO in action. Big threat to markets panicking to partial retreat. So what actually happened? In April 2025, US expanded its tariff regime by imposing 10% flat tariffs on almost all imports. No emergency announcements, no new tax laws, just a quiet change in trade policy sent shockwaves through global economy. For example, if US was importing smartphones from India, it may now have to pay more. So they'll either increase the prices or move production elsewhere. Let's understand this through an example. Let's take something that's simple and easy to understand. Smartphones. Before April, US had not imposed any tariffs on Indian smartphones. So the phone that costed 25,000 was being exported at healthy margins and was pretty competitive in US. In April, Trump imposed 10% tariffs on all the goods. Now when we combine tariffs with other hidden costs, which we will know later in the session, the price raises to 28,250, which made the markets panic. Then came 90 days pause, where these tariffs were exempted on smartphone. So the prices came down to 27,500, where other hidden costs still lingered. Exports picked up due to the 90-day pause. But this isn't going to last long. If tariffs return post halt, the prices, as many expect, the prices may raise beyond may exceed 33,000. So yes, I'm sorry. So how does this change what we think about tariffs? Tariffs used to be way simple. It used to protect industries by making imports more expensive. But now, they have become something else. It has become economic disruptors. They change where companies produce, who stays in business, and how much goods cost. It has also caused global reshuffle of industries overnight. Let's see how business adapted to these changes. Apple, which was assembling iPhones in India, accelerated its production. HP and Dell expanded in Mexico and Vietnam. Luxury brands shifted sourcing to Southeast Asia. But what about small businesses? A mid-sized auto parts supplier in Pune, who used to export more than 60% of its outputs to US, now faced sudden drop in the number of orders. They couldn't afford to relocate or re-strategize, so they had to lay off workers and scale down. Adapting isn't just about business decisions, but it's also about infrastructure and logistics. Trade policy gave countries like India, Mexico, and Vietnam a boost, but it also overloaded their systems, overcrowded their ports, warehouses filled up, and old custom software caused delays. At Mundra port, there was 18% surge in container traffic, but clearance times doubled. So now the exporters had to pay extra charges called demurrage just because their goods couldn't move fast enough. Now there's another hidden cost, paperwork. Change in trade policy led to an avalanche of paperwork. To avoid double taxes or to get more benefits, exporters must now prove the origin of their goods, certify every input material, and pass through multiple verifications. A small textile exporter in Surat lost money on a shipment just because a single certificate was delayed. A ceramics industry in Morbi now spends 15% more on compliance. Tariffs don't just raise the cost, but it also creates another problem, that is currency volatility. Once US tariffs were announced, rupee fell by 3% in a week. Big exporters hedge currency risks, but what about small exporters? It's just another blow for them. Different industries felt these pressures differently. In case of pharmaceuticals, API, which is a key ingredient in their medicines, like painkillers, spiked by 20%. India lost textile orders to Vietnam and Bangladesh. And in case of electronics and automobiles, microchips led to, like shortage in chips led to production shutdowns. Big names like Maruti Suzuki and TVS Motors faced temporary shutdowns due to part delays. Let's see how these costs add up to businesses. In India, tariffs cause double trouble for Indian exporters, even though they don't have to pay double taxes on in legal sense. Here's how it works. When US adds tariffs, Indian exporters may now have to reduce the prices to stay competitive. But back home, Indian authorities will charge GST on the total invoice value and not on the reduced profit. So now the exporters will have to wait for months to get GST refunds. And to cover this working capital, they may now have to take expensive loans. So the same transaction is taxed in abroad, fully taxed in India, and taxed through borrowing costs. Ultimately, all these costs lands on us, the consumers. According to the survey conducted by Consumer Guidance Society, 62% of Indian exporters, 62% of Indian households noticed increase in prices of medicines and electronics, out of which only 18% knew that tariffs were the cause. Consumers are paying tax they never paid for. Consumers are paying tax that they never voted for. And it's not only happening in India, it's happening worldwide. In case of Europe, Europe was highly dependent on China for electronics and machinery. But post-tariffs, they started worrying about cost and reliability on China. That's when India entered. India, with its young workforce and improving supply chain, was the best next strategic alternative. That's when the talks between Europe and India sped up. It's not just Europe that responded to tariffs, there are other countries too that responded. Like France. France added digital services tax. India revised e-commerce import rules. And UK revised customs rules. So when one country imposes tariffs, other countries respond. That's global domino effect. So what can we do? For policymakers, ensure tariffs and GST don't overlap, fix refund systems, upgrade ports, helps small and medium enterprises with paperwork and other compliance. And for businesses, hedge currency risks, prioritize compliance, diversify suppliers, and collaborate with trade associations. Let's wrap up with a final thought. So are tariffs just taxes in disguise? Yes, and they are waivers. They are confusing, hidden, and highly disruptive. India has golden opportunity right now. If we fix our systems and make tariffs more temporary and transparent, we may lead the next phase of global trade. But if we don't, we will be stuck in the maze of invisible taxes and red tape. Thank you. You guys have been wonderful listeners. Let's move towards trade that's smart, simple, and seen. Thank you.
Thank you, Ms. Vaishnavi, for offering such a compelling narrative on global trade. Our third presenter is Mr. Damodar Bhat, who will tackle the topic Adapting Under Pressure Tax Strategy in the Age of Protectionism. Here we explore how businesses are recalibrating tax strategies to survive the global wave of protectionism and technology-led disruption. Our paper presenter, Mr. Damodar Bhat, is currently pursuing his final year of articleship at Ganesh and Sudhir Chartered Accountants, Mangalore. Beyond academics, he has secured first place at the national level drama competition held in Mumbai. He also actively takes part in sports, art and business events, striking a balance between both intellect and creativity. On that note, we call upon Mr. Damodar Bhat to share insights on adapting under pressure.
Good afternoon, everyone. So, I know this is a time where your mind will be negotiating between a good nap and enchi samara indondu kenoda. But I promise you that I won't let you down and change your negotiations to let's listen to him. No, of course let's listen to him. So, next is, hey, Okay, what's the topic by the way? Adapting under pressure in the age of protectionism, right? So this sounds like Enchinana Bagaliye, Artha Iji, but I am there to explain you what is protectionism. So, for an example, how Babri is restricted to enter into Ghada Electronics by Jhetalal. In similar way, Government of India puts restrictions on foreign competitions to enter into India. So it's simple, right? Next. So what are the major protective measures taken by countries to protect themselves? The three major strategies are countries are becoming more specific or more economic protective. And next, rapid technological adoption and increased transparency in financial matters. So how India has taken that steps, do you want to know? Let's move on. That is the New World Economic Protections. The strategies taken by Indian government to protect itself are Atmanirbhar Bharat, that was launched in 2020. Next is Make in India, that is production-linked incentives, where the name suggests production increases, incentive also increases. Next, restrictions on export of SCOMET. By the way, what is SCOMET? SCOMET means export of special chemicals, organisms, materials and equipments and technology which are restricted, which have multiple uses such as mass destructions and civil purposes. Next are higher import duties. Higher import duties can be broadly classified into anti-dumping duties and safeguard duties. So it sounds similar, right? But it's not. So anti-dumping duties are country of origin specific, whereas safeguard duties are not country of origin specific. Anti-dumping duties are the duties imposed when the foreign company sells goods less than the fair market value or lower than the cost. That is kachre ke bhav mein. Next is safeguard duties are the temporary duties imposed to protect the internal industries by the government, which helped the companies like Tata Steels, SAIL, Adani Solar and Vare Energy from disrupting their operations. Next is the technological revolution in tax collection. So now, do you remember, can you imagine one thing, that income tax officer or any tax officer coming and checking your ledger manually? Now it's not. Now it's AI and tech, baby. So they are, the AI is scanning your returns faster than you scroll your Instagram. So technological revolution in tax collection. Next, GST network in India. So what is the current status? What is the future technology? And next is artificial intelligence catching the tax evaders. So what is currently happening is real-time tax monitoring. That is e-invoicing, real-time ITC matching and blocking the credits. I know all these things are repetitive, so I won't dig up deep into it. So next is future technology that may be adopted by GST network in India, that is blockchain. So what is blockchain, how it works, that will be handled by my fellow mate Aditya Pergade, but broadly, blockchain means digital ledger that cannot be altered once the entries are made, which ensures compliance. Next is artificial intelligence catching the tax evaders. So artificial intelligence is broadly used in two ways, that is fraud detection and prevention and smart compliance for return matching. So these are some points which can be used, how AI tracks the tax evaders. Next, let us take an example where GST authorities used the AI tools to catch a racket of fake invoicing worth rupees 45,000 crores. Amazing, right? So companies were issuing fake invoices just to claim the other person, just to make the other person claim inputs on those purchases. So next, so do you know one scary part? The government of India knows about your lifestyle more than your ex. So that is the transparency era, dude. So next is information sharing between countries. So India shares its information, that is financial information, over 95 plus countries through DTAA, and there are 13 plus FTAs, that is foreign free trade agreements with various countries. So if you have an account in Singapore, please disclose it, and don't forget that Income Tax Authority has the access of information. Next is public disclosure requirements, that is country by country reporting, related party disclosures, financial disclosures as per Companies Act. These things are repetitive, so I don't dig up deep into it. Next comes big data tax administration. So it sounds unique, right? Big data. That's simple. I'll explain this by an example that you are buying a car where multiple data points reach the tax authorities, that is banking financial details, insurance information, registration data, GST on car purchased, and income tax details, by which the government of India can reconcile your income with your lifestyle with your declared income. Next comes how companies are adapting. So, in the modern era, companies are not just updating their servers, but they are updating their survival instinct. Because if you miss one return, bam, it's a penalty. If you mismatch your inputs, bam, it's a notice. So, companies should be more accurate in their tax strategies. So these are the tax strategies which are used by the companies in modern era to protect themselves from the protective action taken by the government. That is integration of Indian trade portal with the internal softwares, which will enable them to select the best alternatives for the exports, automated compliance. And these services are provided by a company called SAP Global Services, right? And what are other tax strategies? That is restructuring of purchase and sales for tax optimization. So, while purchasing, you could purchase, import through SEZs, which will reduce your tax, import duties, and also give the benefit. Next is import of unfinished or semi-finished goods. So, for a classic example of this, I can give an example of Apple. So, Apple is not manufacturing their whole of the product in India, but they are importing the parts, which reduced their custom duties from 20% to just 10%. Next is supply chain restructuring. What is supply chain restructuring? If you have a centralized supply chain that from if you are manufacturing at Gujarat and selling it all over the India, so it should be restructured to regional offices where you could claim your inputs early, which will reduce your working capital and cost on working capital. So these are some huge companies which restructured their supply chains, which benefited them a lot. So Bajaj saved around 20% of their logistic costs by restructuring their supply chain. And next, Hero MotoCorp maintained a market leadership, ensuring the compliance. Next is global technology in information technology sector. So Infosys and TCS are the huge companies which operate across all over the world. So these need a greater compliance model where Infosys used and created a model of AI powered system which will predict the tax and ensure the compliance, whereas Tata Consultancy Service it has achieved zero GST penalties despite of the complex operations in 150 plus locations. Next is technology in retail and e-commerce. So in e-commerce, Flipkart is known as India's most GST compliant e-commerce platform. Why? They use an end-to-end ERP system where if you press a buy button in the Flipkart app till the item reached your home, each and everything is tracked through a single system which ensures proper compliance, and they use a model called just in time which reduces the inventory cost too. So what is the recommendation to companies? It is the boring topic, but I'm praying you're not asking me that how much implementation cost will occur. So action plans. These are immediate action plans which can be taken, that is technological upgradation, process improvement, and risk assessment. Next is medium-term strategies, that is supply chain optimization, digital transformation, and capability buildings. Next is long-term strategies, that is strategically positioning themselves to gain an edge. And next is innovative leadership. At the conclusion, I want to say that these are the key success factors which were observed in the huge companies which survived these long many years. That is, they are embracing the technology, stay flexible, think strategically, and be fully compliant. At the end, it is the thing that the people who survive are the people who take the challenges as an opportunity rather than taking it as a threat. So, I thank you all for wonderful patience and post-lunch energy. and the good skill that you have, you are not, no, you are pretending to, you are not sleepy. So please scan this QR to access the PPT and a good example of supply chain restructuring. And I'm looking forward for your valuable feedbacks. So you can please scan this QR. So I want to thank you all for giving me this beautiful opportunity and the guidance by Daphne ma'am. Thank you, ma'am.
To Mr. Damodar for spotlighting how businesses are recalibrating in this volatile ecosystem. Finally, we have Mr. Aditya Pergade, who brings a tech-forward theme, clearing the chain, blockchain's role at the customs gate. From shipping ports to smart contracts, this paper highlights how blockchain is redefined the customs and tariff. Our final presenter, Mr. Aditya Pergade, is a CA finalist from Mangaluru. Pursuing his articleship at Ganesh and Sudhir Chartered Accountants, Mangalore, he served as the treasurer of Sikasa Mangaluru in 2020-23-24, during which the branch earned a national recognition. Aditya Pergade has been awarded Best Paper Presenter at Jnanamanthan 2024 and was also honored the Best Outgoing Student of Trisha Evening College. His accolades span both academic and cultural areas, including wins at national level drama competition and serving as the MC in International Kite Festival in Mangalore. Now, let us invite Aditya Pergade as he presents his topic, Clearing the Chain.
I once heard someone say, if aliens were to land on Earth and they saw how we manage international trade, they would think our most powerful weapon is paperwork. Honestly, they may not be wrong, because clearing a container through customs in 2025 is a murder mystery. With 5 witnesses, 3 witness statements, at least 1 certificate missing page number 2. And just when you think you have got it all figured out, someone comes and says, Anna, this form was supposed to be filed in triplicate last Tuesday. That's the sound of global trade on the move. Containers, commodities, and consignments. What's often missing is clarity. Customs operation today is heavily reliant on manual checks, paper documents, and disconnected systems. And certificates of origin are verified through printouts or emails. Bills of lading is physically stamped. And if 2 departments have to share any information, it probably involves a courier. In many countries, including India, where hundreds of consignments are cleared in an hour, but using a system that was designed for a much slower world. So when we hear someone say something high-tech like blockchain being implemented here, our natural reaction would be,
Tecnologia! Tecnologia! Tecnologia!
Technologia, indeed. But first, Aditya, before we dive into anything, what the hell is blockchain? Blockchain is a distributed digital ledger, a way of recording transactions across multiple computers known as nodes in a secure and tamper-free manner. Now, here each transaction is grouped into a block, and before it is added to the chain, it must be validated through a process called mining, where complex mathematical formulas are solved to check if a transaction is legit. Once it is verified, it's sealed using cryptographic hash, which is a unique digital fingerprint which links it to an immediately previous block of the chain. Hence the name blockchain, groups of transactions which are linked to one another. Now, once it's added to chain, it cannot be changed, because if it's changed, every subsequent block also needs to be altered. But what's the hype between blockchain and customs? It is because blockchain directly tackles the weaknesses in the current system. Decentralization. The current system is very centralized. If any one server fails, the entire system is compromised. In blockchain, since the same data is stored across multiple computers, there is no question of single point of failure. Immutable. Once the data is stored, it cannot be changed, as I said. And if someone tries, the cryptographic hash changes and system immediately detects a mismatch. Transparent and privacy. Now you might ask me, okay, if everyone can see the data, isn't it a privacy risk? Not really. For anyone to access the data within the block, you need to have a unique private key. That is, if customs officers need to verify trade document, they can do so without divulging any sensitive business information. Smart contracts. These are programmable conditions in the blockchain. For example, as soon as the goods clear customs, immediately deduct duties from the importer's account. No hassle, no manual intervention, no delays. That is the power of blockchain. That's the disruption it causes. Okay, too much theory. Let's come to a real-world example that sums up the power of blockchain in a single word: traceability. In 2017, Walmart wanted to know where a single slice of its mango came from. Using traditional systems of phone calls, spreadsheets, and paperwork, it took them 7 days. In blockchain, just 2.2 seconds. That is the power of blockchain. The customs officers can trace goods, whether it's from cotton from Egypt, steel from China, without relying on any fraudulent documents. But now let's move to more custom-specific use cases. As verifying origin as per trade agreements. According to United States, Mexico, and Canada agreement, goods originating from North America and produced by workers earning at least $16 per hour get concession in tariffs. That's not just checking about origin, but it's also checking about labor compliance. Using traditional system, it's stacks of certificates, signatures, and just hope. And then they tried blockchain in 2018. The result, real-time validation. Fighting transshipment fraud. Companies often route their goods through third countries to avoid duties. But here, since blockchain tracks the good right from origin to the end, there is no scope for such a fraud to happen. Automating duty collection. Traditionally, duty is collected once the goods clear customs. But this causes delays, frauds, etc. Blockchain switches it. As soon as the goods clears custom, duties are deducted. If there's no balance in the importer's account, the goods are blocked. Third, repeated defaulters are flagged. Now let's come back home, Bharat. While India's import-export operations have improved a lot, it still faces bottlenecks. This is how blockchain can improve our system. Paperless trade. Our document-heavy processes can be integrated with blockchain to ensure a seamless system. Faster payments. Using apps like RippleNet, Indian banks can settle cross-border payments seamlessly, faster and cheaper. Small and medium enterprises encouragement. For these entities, getting trade finance is incredibly difficult. However, due to blockchain and smart contracts, their payments can be processed as soon as the goods clear customs, without the need for any LC, letter of credit, or big banks. Policy momentum. India is not holding behind. RBI's sandbox, the national blockchain strategy, and initiatives from Ministry of Commerce all point to the direction. Origin enforcement. After the recent Pulwama attack, India banned all Pakistani goods. But enforcing this ban is difficult because they often route their way through third countries. Since blockchain is present, it ensures that Pakistani goods does not suddenly become UAE and enters the country. But as with any technology that is there, everything comes with its own challenges. And blockchain is not left behind. Garbage in, garbage forever. Once a wrong data or manipulated data is entered, it becomes permanently wrong in blockchain. Scalability issues. Customs processes huge amount of data, millions of transactions in a day. And implementing this in blockchain involves massive infrastructure and computing power. Awareness and costs. Banks, SMEs, various parties are not aware of how blockchain works. and the cost is immense. Siloed systems. Now, if each country develops their own blockchain system, how do we integrate it? This is one of the issues of blockchain. While all these issues are just bumps on the road, nothing can be overcome with the right intent. Finally, while it is true that blockchain is just a buzzword, it is now moving from hype to pilot to real-time productivity. And it comes at the right time for India as we aim for $2 trillion exports and we aim to climb higher in the ease of doing business index. It is perfect and can help implement the system at present. Imagine this, a farmer from Punjab tracking his basmati from field to foreign port. The customs officer verifying it in seconds and him getting his payment instantly. We are not there yet, but Manas Mantunda, Apundanda, Apundanda, Apunde. Thank you.
What a futuristic yet practical take on blockchain's entry into the realm of tariffs. Thank you, Mr. Aditya, for that fascinating perspective. Now that we are intellectually stived and significantly more informed, I request CA Daphne D'Souza to share her insights and observations on the presentation and perhaps stitch the learnings into a cohesive narrative.
Thank you so much. 4 wonderful presentations. Congratulations, Nisha, Vaishnavi, Damodar and Aditya. So, did you all understand their presentations? How many of you understood what they were presenting? AI and some digital and some place of supply, it seems. Did you all understand it? Very good. You all are on dot. I am somewhere behind. So, thank you for the updates. And when I was going through their presentations, I didn't come up with solutions. Instead, I came up with more questions and more problems. And when it's GST, as the High Court judge once commented, you know what he said? He said, man has gone to the moon and come back, but your GST laws, nobody will understand even today. This is what he said. So with this, a lot of questions came in my mind. I will put forth these questions without expecting an answer, and I'll do it within the time allotted to me. So, if you all are able to help me out with the answers, wonderful. And these are my questions. So I have a client who's located in Coimbatore, and he's engaged in this interior decoration glass, you know. So this glass was not really made or manufactured in India. So what my client had to do is, he had to go to China, get this glass, and he did his research and he understood that nobody else in the country manufactures this kind of glass. So he came to India and with the help of blockchain and AI, quickly got his goods cleared, paid the applicable customs duty also. Boom, in 2 or 3 years he gets a notice saying that there is one manufacturer in the country who manufactures the same kind of glass, and so you will now pay anti-dumping duty. Comes after 2-3 years notice, so pay duty, pay interest, pay penalty. Now we'll put this in the context of protectionism. Protectionism, we often ask, Trump is ready to put duty on us. Should we also not retaliate by putting duties on them and on other countries? So now what happens when we buy something that's really required for our country and we end up importing it? Does protectionism harm us then, or does it help us?
Check. Even I had that dilemma that protectionism is beneficial or it is harm. So I didn't put that question because the same question will come back to me.
Oh, see, I came back with the same question.
Yeah.
Yes. So what do you think, Vaishnavi? Should we retaliate with more tariffs? No, yes, we don't know, correct? Yeah, so we don't know what we need to do. But Vaishnavi gave an answer there. She said we've come up with import rules. We've come up with more import rules, which is very apt and which is required. Now, blockchain, AI and all of this is supposed to help me out, correct? Which means that once my goods have crossed my country, it has entered my country, ideally I shouldn't be getting any notices, correct? I have got a certificate of origin saying that my goods were manufactured originally in Vietnam, therefore I have zero tax to pay, because if it's manufactured elsewhere, I have so much of tax to pay. So I see to it that I go only to Vietnam and I buy my particular product. I've done that. I'm a very diligent importer, okay? I've done all of this, and then the goods are with me. I have started manufacturing my product. Let's say I'm manufacturing chocolates. I've done that. Everything is over. Finally, after 5-10 years, the enforcement knocks at my door and tells me that your goods were never originated from Vietnam. The guy who sent you the goods cheated you. Your goods actually came from somewhere else, some other place. But he secretly brought it to Vietnam and he then brought it to India, thereby saving you from duty. Now, congratulations, pay tax. Pay tax with interest and penalty. How can blockchain help me here?
Blockchain is one of the exact tools that helps avoid that case to happen.
Correct.
Since it traces where the goods has come from the original point of view. And to ensure, as I told, one of the challenges, garbage in, garbage forever. There is different modes of validation which ensures that maybe GPS, maybe it is GI, through GI it is done, or GPS, it tracks the location of the origin of goods. Once that validation process is done, it is sealed forever. But one of the issues is, now mankind is always smart. He thinks he's smarter than the machine. What if he comes around that validation route?
Exactly.
There's always scope for improvement in that.
There's always scope for improvement. First row seems to be very elated. Okay. Then what happens? Now we'll come to places like Mangalore. A lot of YouTubers and influencers have started cropping up from everywhere. So we keep getting these queries. Should I pay GST to register with YouTube? Am I liable? No? Not liable? Okay. So questions have started coming like, I met one Kannada film producer. He came up with a very good Kannada movie. It was a blockbuster hit and everything. Now he's called the content owner. He wanted to sell his rights in the movie to somebody. Say that person, the company is located in Hong Kong. And this company said that I will put so many ads of your movie that everyone will start watching. In the sense, who knows, even Amazon or Netflix or Jio or Hotstar, somebody will buy your movie. This was the intention. Now for the content owner, our Kannada film producer, we know what is the liability. Question arose, what should the company in Hong Kong do? For advertising the movie in India, should they take registration or not? Was the question. So where do we stand with these kind of things? Netflix, yes, we pay some GST. ChatGPT, yes. These are high-level people. But what about our localites? What about those people who provide services to YouTube? We may treat it as export of services, but what about services like branding, sponsorships? We receive Indian brands, Indian ads, Indian people are paying us, foreigners are paying us. So this confusion always stays. So what I can tell you is AI can assist us. Little difficult to overtake us because as he rightly pointed out, human beings are capable of tweaking things. So what matters are facts of the case. So therefore, read every day, and I think GST is one of the most wanted chapters for chartered accountants who want to do well. Thank you so much for your time, guys.
Thank you, ma'am, for your sharp observations and for connecting the dots so lucidly for us. As this engaging session comes to a close, may I now request CA Bantwal Nitin Baliga sir to present a token of appreciation for our session chairperson as well as the paper presenters for sharing all their knowledge to this amazing audience. Up in this intricate dance between tax and tech, success lies not merely keeping pace, but in anticipating the next move. Thank you all for being a wonderful audience. Let us carry forward these insights into our studies, our profession, and perhaps one day into shining the future of policy itself. Stay curious, stay informed, and above all, stay relevant.